Okay, good morning, everyone. I hope everyone can hear me. If you can just bring up your chat window and please type yes into the chat window if you can hear me. Okay, perfect. Thank you so much for joining me this morning in these volatile times. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. Some of you might know me as the host on Options Action on CNBC. I'm here to do a fairly special event for you guys during these very volatile times. And I'll just start off by saying, I hope everyone is doing well. Please stay safe and think of others during this time. We all need to do our part right now because this coronavirus is causing quite a bit of volatility in our markets. So today what I'm going to do is I'm going to spend a bit of time reviewing the current markets, what we're currently seeing in the markets. I want to talk a little bit about how to position yourself utilizing options. Some of you may be trading options, some of you may be trading stocks. And we want to talk a little bit about what has shifted over the last few weeks so that if you're going to be trading options, how should you be positioning yourself? And during these trying times, I want to point you into the research that we're currently looking at, because I think if you read the news, if you read different sources of information, there is a lot of stuff out there. And how do you actually take all that stuff and boil it down to the stuff that's really important? So I want to share with you the research that we are paying attention to inform our macro decisions, and then talk a little bit about some of the technical levels that we are looking at. So let's go ahead and get started here. Just a quick disclaimer, what I'm going to discuss here is purely for demonstration purposes. The examples that I'll be showing you is for educational purposes and is not a recommendation to buy or sell any specific securities. So first and foremost, I want to start off our event by saying that everything that I'm going to be talking about here today is changing very, very rapidly. I've been doing these type of market sessions for just the last few weeks, and things have shifted completely in the last couple of weeks. So what I'm going to discuss here today may be very different next week. So that's why I'm going to come back on Tuesday of next week at the same time, 8:30 in the morning, to update you on anything that has changed. So first and foremost, I think what we want to establish is that, first of all, I think it's pretty clear that we are currently in a recession. As much as perhaps technically we might not be, because the GDP data that for the Q1 and Q2 have not come out yet, all models currently show that we are, not only the US is in a recession, but globally we're seeing zero growth for 2020. So first and foremost, I think we need to reevaluate how we're investing, how we're thinking about the markets, by talking about the fact that we are currently modeling that we are going to be a recession in 2020. I will say that the models also state that by the end of 2020, we should come out of that recession. Again, things are changing very, very quickly. Data is coming out every single day that's impacting these models. So we want to discuss what some of those models are. What are some of the economic indicators that we're currently looking at? The second thing I want to discuss is the fact that there's been a major shift in trading over the last few weeks. Number one, implied correlations are very high. So I'll talk a little bit about what that means. But more importantly, for those of you that are options traders, spreads are really wide. So what that means really, and I'll get into the details of it, but the conclusion for all of that is that what you should be trading right now is more leaning towards single stocks as opposed to, you should be trading ETFs as opposed to single stocks. ETFs are liquid. ETFs you can trade in and out of. Spreads for those are still relatively small and tight versus single stocks. So in these types of times when things are very volatile, especially if you think volatility will continue in the future, lean towards trading ETFs rather than single stocks. And I'll discuss some of the reasons as to why. The big unknowns for us that really impact our directional view going forward are a few different things. First and foremost, I think the coronavirus containment trends are the most important ones for us to keep track of. These trends are changing every single day. If you watch the news, you're going to get a flurry of numbers thrown at you. So I want to put this into the context of how we're looking at the numbers to determine whether or not the containment trends are staying on track or if they're getting worse or better. As of right now, we are still somewhat on track, but we are close to potentially getting a little worse. So I want to talk you through what type of numbers we're looking at. Next, I think the most important thing is measuring economic impact, both in magnitude and in length. The good thing is that we now have a baseline to compare to. Looking at China, we now have economic data out of February to give us an understanding as to both the magnitude and the length. That is our template to apply to Italy, to apply to US, and apply to other countries. And the question is whether or not we're going to follow that type of economic impact, or things are going to get better or worse. The next thing I want to take a look at is corporate debt. Now, this was a huge concern in the markets. This is really what caused some of the acceleration of the sell-off. Now, I will say that the Fed stepping in over the last week or so has caused these concerns to ease a little bit, and I think that's what's causing this little bit of calm that we're currently seeing over the last couple of days. The question is whether this calm is going to stay, whether it's going to continue, or it's going to get worse. We're going to look at some of that data. But the first piece of economic data that we're currently seeing is really unemployment. So I want to talk to you through some of the unemployment numbers, because this is going to have huge ramifications on our government. And this is the part that the Fed cannot fix. The Fed easing interest rates, the Fed doing liquidity operations, repo markets, it's not going to fix unemployment. So really where it comes down to is our fiscal policy. What are we going to do to offset the estimated $3.5 million jobs that are going to be lost here in April, and the uptick of unemployment, because this is truly a black swan event. Normally for unemployment to go from 3.5% to 6.5% takes a bit of time. But all of a sudden we're getting this huge spike in unemployment very, very quickly. So this requires very fast government intervention on the fiscal policy side. So far what we've seen is decent monetary policy to address the corporate debt market and address the liquidity concerns in the market. The question now becomes, what is the federal government going to do to address some of the items that we cannot fix through monetary policy? And then lastly, what I want to talk about is how to position yourself using options, predominantly looking at calendar and diagonal spreads. For those of you that are brand new to options trading, this may seem scary, but I want to try to break down calendar and diagonal spreads to something that you guys can understand. So let's go ahead and get started. I don't have a lot of time, so I want to first talk about implied correlation. So implied correlation simply tells you how correlated are stocks to each other. So if we look at February 19th, which was the all-time high, the market was around 35 or so, 37 or so. So stocks were not very correlated to each other in the high 30s. As the market sold off, implied correlation peaked at about 97%. But notice how over the last couple of days, it has pulled back to roughly that 70% level, but still, that is a large amount. That is much, much higher than where we were near the peak. And what that means is that stocks are moving in lockstep with each other. So in this type of environment, generally speaking, it doesn't make a lot of sense to pick individual stocks, because pretty much when the market moves higher, all stocks move higher. When the stocks move lower, all stocks move lower. So in this particular environment, number one, generally speaking, you're better off trading the ETFs like SPY or QQQ, because all stocks move anyway. You might as well trade a single item versus a lot of small different stocks. But the second reason why I think it's important for us in this type of market environment to shift towards trading ETFs is because liquidity has completely evaporated from the markets. Now, here at Options Play, what we do is we scan for liquidity of options. And normally when we look at the options market, when we looked at on the February 19th, the number of what we consider very liquid options usually is about 100 to 150 names. Right now, that number is only 15 names. So there's only about 15 names where the bid-ask spreads are tight enough for us to consider this very liquid. Normally there's about 150. So there's only 10% of the normal volume that is considered Liquid. Everything else spreads are really wide. Now, names that are normally in the very liquid column, like Google, Twitter, Disney, Microsoft, Netflix, these types of names are now what we consider somewhat liquid. Now, the somewhat liquid name usually spans about 300 names or so, 300 to 400 names. Now, there's only about 17, 18. So based on that, our thesis is that when you're trading options today, you should focus on the super liquid ETFs like SPY, QQQ, IWM. If you're trading broad-based index, large cap, or small cap, these are the names that you should really focus your attention on, simply due to the implied correlation and to liquidity. I hope that makes sense to everyone. Please type 1 into the chat window if that makes sense. Now, turning over to the looking at the market, we think about the market, and this is just to put into the context, this is the rally from 2009 to February 19th. The market has now corrected roughly 35% from that low. Now, right now, 235 is a major support level that we've kind of held for a while. Looks like we're about to open a little higher, about 241. So we're still above that 235 level, 1/3 of the pullback. The question right now is to whether that 235 level will hold. We can certainly look at that from a technical perspective, but I think in these times we have to look at more fundamentals. So one of the things that we use is the Johns Hopkins coronavirus tracker. And as you can see, this orange line is the number of cases in China that has pretty much tapered off to zero growth, and this yellow line is growth outside of China. And as you can see, this has accelerated substantially. The number of deaths have greatly exceeded what we've seen in China, and the number of cases have exceeded China. So everything is pointing to a concern. But looking at that chart sometimes I think is a little misleading. This is a chart of the number of cases since the number of new cases. And what we're looking at from a trend perspective is not the sheer number, but the growth in terms of the number. Now, if you notice in China, this growth number peaked around 21 days from when they had about 100 cases. And then after 21 days, the data started to decrease. Now, the question is, are countries like Italy and USA going to follow a similar trend? So the green line is Italy. And the question is whether or not Italy will also follow this trend where it peaks after about 20 to 23 days. That seems to be the data that we have out of China. Or are the cases in Italy going to grow for a few more days before it tapers off? Now, because the growth is exponential, it has a much larger tail. And this is important because we need to try to measure the economic impact for a country. So looking at China, we know how long it lasted. We now have some early data to show us how much of an impact does it really have. And that's why this is so important for us to track. So right now we are just around the 22nd day for Italy. So the question is, again, whether or not over the next few days we're going to see Italy trend lower or trend higher. Because if it trends higher, even for a few more days, what that really impacts is the tail end. And so in China, what we've really been able to see is the economic impact between this point and this point, roughly 1 month, is roughly 30 to 40% decline in economic activity. And what's vastly different between China and the US is the fact that China created some pretty draconian measures to lock down their citizens. We have not done that in Italy. We have not done that in the US. California did just lock down all their residents. So hopefully we see some of that in the US. So these are the data points that we're looking at, and whether or not we do our part in social distancing and lockdown and help slow down the spread of the virus will have a large impact. So right now, the base case, based on early data out of China, is really the fact that we're going to see roughly a 30% decline in activity through April. Personally, I think that's a little optimistic. but that's yet to see. I think a deeper, some of the what we call the bear case is more of closer to about a 50% plunge by April. The best case scenario is that we only see about a 20% decrease. Now, I will say that some of what we have to factor is two things: magnitude and length, right? So China was able to contain their economic slowdown for roughly about 1 month because they had pretty draconian measures, and we saw about a 30-40% decline in economic activity during that time. The concern that I have with the US is that, or with Italy, is that we didn't produce those draconian measures. So likely what's going to happen is that we're going to have a smaller economic impact, but it will last for much, much longer. And it's still too early to really see what the impact really will be. But some of the numbers that we are taking a look at, some of the things that we're currently looking at is, number one, the corporate debt market. The corporate debt market has blown out of the water. This move in both the investment grade and high yield grade, notice how it still is well below the 2008 highs, which is good. And that, in my opinion, is as a result of the Fed stepping in, doing their liquidity operations in the markets. So that is one thing that we're tracking. If this thing blows past 2008 spreads, that certainly will be concerning to us, and that would probably lead to further sell-off in the equity markets. So that's a very important indicator to take a look at. The second most important indicator I want to take a look at is really unemployment claims. This is a high frequency data point that comes out every single week. So this is something that we can track much closer than GDP, that only comes out once a month, and GDP lags for quite a few months. This is very high frequency data that we can see in real time. Notice how in 2008 it took quite a few years for us to peak, but notice how here in just 2 weeks we went from 210 claims to this week, at the week ending in March 21st. I'm expecting that this number is closer to 3 million, because in just 15 states, we're at already 629,000 claims. Again, which means that once all 50 states come in, that number is closer, probably going to be around 3 million. So this is the black swan event here, truly black swan event. Now, I will say that we do expect, as the fact that this grew very quickly, to also come down relatively quickly. But I also still, looking at Chinese data, we still expect that taper off to come off relatively slowly. It will be a little faster. It'll probably look something more like this, but it won't be just because we get a quick spike up does not mean that we're going to get a quick spike down. So right now, fiscal policy that we do in the US will hopefully help ease some of that a little bit, but that's really some of the data points that we're looking at. So lastly, I want to talk a little bit about options. Now, how do you position yourself here utilizing options? Options are really expensive, right? Any option that you take a look at, if you look at SP, let's just take a look at the Qs. To buy a 1 month or 1.5 month at the money call right now costs $1,500, $15.53. Normally, this would probably cost you somewhere, when things were normal, about $3-4. Now it's about 4 or 5 times that, because volatility has exploded. VIX has gone from roughly in the 10 to 15 level. Now it's trading at 68. Looks like we're about to open a little lower here today as equity markets ease, but the VIX is certainly significantly higher. So options are much more expensive. So how do we position ourselves for this? And the key here is really that because VIX has exploded, short-dated vol has really just blown out of the water. And we can use that to some degree to our advantage. And I want to go through some examples as to how can you use this short-term explosion in vol to your advantage when you're trading options. So the right way to position yourself is to really use calendar and diagonal spreads, which means buying longer dated at the money options. So what you want to go is further out in time here, roughly on the curve. You want to go maybe 3 to 6 months out. And then what you want to do is you want to sell really, really short dated options and try to offset the the cost of buying that really expensive option. That option is going to be expensive no matter where you go, but what you can do is you can try to offset that by selling some short dated options against it. So an example that I have up here is using the Qs. And this is, again, just purely for educational purposes. It's not a solicitation to buy or sell this specific security. But let's just say you were being optimistic and you think that over the next few weeks, we could get a recovery here. Maybe because you believe that the number of cases are going to come down. You think we're doing a lot to offset the slowdown in the economy. So let's say you want to buy a June 185 call. That costs you $15.15. And then what you can do is you can sell a very short dated vol. So the June option expires in 91 days. So you have 3 months of time. And then what you can do is you can sell a 1 month option, 1 week option against it, the same 185 call, and collect $5.06. So you're offsetting the cost of your trade by a third. So I just want to walk you guys through some of that math here. In this particular example, if I buy this June 185 call costing me $15.50, that puts my break-even price roughly $15 above 185. So the Qs have to go all the way up to 200 just to break even. That's a pretty big move, right? So how can we reduce that cost? We can reduce that cost because the short-dated options are even more elevated. So you can collect just $5 by just selling the March 27th 185 calls. And the goal here is so that you're buying yourself long-term upside here. You're buying yourself that call option, and you want to try to buy that call option for as cheap as possible in the long run. You can do that by selling short-dated options against it. So in this particular case, on March 27th, if the markets are above 185, if the markets are above 185, then what you have to do is you have to buy back the short calls. Ideally, what you want to happen is you want to select a strike price that you think that by March 27th, the stock will be below 185. Because if it's below 185, then this call will basically expire worthless. You will keep your $5.06, and now you've reduced your total cost down to just about $10. Now, if you're able to do that multiple times, now the great thing about options is that right now you have a lot of options that expire very frequently. So you can sell the weekly options on March 31st. You can sell another option that expires on April 3rd. So by next week or 2 weeks from now, you could have collected maybe, let's say you collect $5 here. Maybe you collect $3 here because that is just a few days from there, and this one another few days from there. Let's say you're able to do that. Then what you're able to do is reduce your cost by $8 and another maybe $11. So by the time that April 3rd rolls around, you've reduced your cost of this trade from $15 to roughly $4. And notice how if you bought this 185 call for $4, then your break-even price is only $189. So that's how you have to trade during this type of extreme volatility, is to buy the long-term exposure that you're looking for. It'll be very, very expensive, whether you're looking to buy long-term calls or long-term puts, depending on your views. That, again, the research certainly at this point is skewing more to the downside again. So regardless of whether you want to buy long-term calls or puts, because your directional view is either bullish or bearish, you want to always consistently sell very, very short-dated calls or puts against it to offset the cost of that long call. And as you can see here, normally it might take me, during normal times to sell. Normally I have to go out maybe 2-3 weeks to get this type of premium. Now I'm getting in just a single week. So now what you're doing is you're accelerating the reduction of the cost of that call option that you're buying by selling very short dated options. So that's how you want to think about positioning yourself here in the markets. Now, if you're brand new to selling calendars and diagonals, that's okay. That's really where you want to start learning a little bit more about these days if you're thinking about trading options. The other thing, again, is make sure that you think about sticking to the very, very liquid SPY and QQQs. I know there was a question here about trading inverse SPY and Qs. Keep in mind, inverse SPY and Qs are are much smaller ETFs. There's no liquidity in those at all. So I do not recommend that you touch the inverse ETFs unless you're trading just the ETFs themselves. But even then, keep in mind that those are only meant to provide inverse returns for a single day. If you hold on to those for multiple days, you will start to drift away from a short SPY or QQQ position. So be very careful when you're trading those either leverage ETFs or inverse ETFs. So with that, I just want to thank everyone for taking the time out here this morning. I hope that this was useful in giving you a better understanding as to how to look at the markets, how to position for these markets. And I will be back here on Tuesday morning at same time, 8:30 a.m. to inform you of any changes that we currently see in the data points that we're tracking. So I hope that you guys were able to take something out of this, and I hope that this helps sets you up for your trading day. Again, please stay safe and think of others, and I will see you guys on Tuesday. Thank you so much.